What is LTCG grandfathering? How do we calculate tax on stocks and equity mutual funds from the current financial year? Hi, I'm Pattu from FreeFinCal, and let's consider what LTCG grandfathering is in this video. Let's say I purchase some units of a mutual fund, equity mutual fund, or some stocks on July 1st, 2016, and I want to sell it, let's say on April 13th, 2018. So the first thing to consider is that the units or the stocks are more than a year old, so more than 365 days old. So LTCG taxation rules will apply to the current sale. And next, let's consider a situation in which the price on 31st January 2018 is higher than the purchase price in 2016, and the price on April 2018, that is the date when we are going to sell, is higher than both those dates, both January 2018 and 2016. So that's the graph of the price movement of the mutual fund or the stock that you see. I have deliberately avoided talking about actual price values or NAV values in this video because I want you to visually get an idea of how this taxation rule works. Now let's calculate LTCG tax for this situation. The first thing to note is we have a profit from 2018 31st January and July 2016 when we actually made the purchase. This profit is completely tax-free due to the grandfathering rule. That is, in the current financial year, we are applying a rule which was applicable in the previous financial year, where LTCG tax on equity was tax-free, and we are applying it for all gains made up to 31st January 2018. So the application of an old rule in the new financial year is known as grandfathering, and this profit between January 31st 2018 to 2016 is completely free of tax. Now notice that between April 2018, when we are going to sell, to January 2018 there is some profit. This profit is taxable if the sum of all such profits or all such long-term capital gains is greater than 1 lakh per financial year. So for example, if this profit between April 2018 to January 2018 is 50,000, it is not taxable. If this profit is 1 lakh, it is not taxable. If it is 1 lakh 25,000, then you will have to pay 10% tax with 4% cess on the 25,000 alone. So it's the tax you need to pay if you sell in this situation is quite small, so don't worry too much about it. So that's the first example we'll consider. The next example is we have price movement in which the price on January 2018 is higher than the price on 2016 when we actually made the purchase, but the price today, that is in April 2018, is lower than the price on January 2018. This is the situation for practically all equity mutual funds except arbitrage mutual funds and many stocks. So what is the tax to be paid in this situation? Again, let's apply grandfathering. The profit between January 2018, 31st January 2018 and July 2016 is free of tax. Then if you consider between April 2018 and January 2018, there is no profit. There's actually only a loss. Therefore, there is no tax to be paid. So the net LTCG tax in this case is zero. You don't have to pay any tax. This is the reason why if you are going to switch from regular mutual funds, that is the ones which take commission from your investment value, or if you want to switch out from a mutual fund that has changed investment strategy because of the SEBI categorization rules, you can do so right now, because for most mutual funds the current NAV, that is in April, mid-April, will be lower than the NAV that was prevailing in January 31st 2018. Therefore you will not have to pay any tax and you can safely switch or exit. Of course, this will not apply for arbitrage mutual funds. For arbitrage mutual funds, the previous example will apply. So that's the second situation. Now look at a third situation in which when you sell, that is in mid-April 2018, the price is lower than both the price that was prevailing on January 31st 2018 and the purchase price in 2016. So again, if you calculate, the profit between January 31st 2018 and 2016 July is tax free because of the grandfathering rule, and then between April 2018 and January 2018 there is no profit, there is a loss, therefore there is no tax to be paid in this situation. Also, there is one more advantage. If you look at the price on the day you sold, that is in April 2018, this is lower than the price when you purchased. Therefore, there is a net loss in the transaction. This loss can be offset or can be deducted from any other long-term capital gains that you have incurred in that financial year, or if you do not have any long-term capital gains in the present financial year, that is in 2018-19, you can carry forward this loss for the next 8 financial years and set it off whenever you want. But if you want to carry forward it, such a loss, you will have to report it every year in the income tax returns. So those are the 3 situations in which you have LTCG taxation. Please recognize this 3 situations will have to be considered for every mutual fund unit you have purchased or every stock you have purchased. So if you have a SIP running, a systematic investment plan running, you will be buying a few units every month. So you will have to undergo this calculation for every unit you have purchased. So this, you don't need to do it by hand. There are 2 options. One is you can get a capital gain statement from the mutual fund house, but such a statement will tell you about loss or gain only after you make the redemption. I have a calculator. The link is given in the description box below. You can use that calculator and estimate the LTCG or the LTCL, the loss, before you actually make the redemption. So catch you again in another video. Bye bye.